Hello everyone, today we are going to pitch a trading strategy that lots of you might heard before but did not dive through. It's pairs trading. Our pairs today would be PepsiCo and Comcast. A brief introduction with pairs trading. It is a market neutral strategy that simultaneously long and short a pair of stock. It hedges out the systematic risk and the directional risk as well. Given the macroeconomic environment is tightened, interest rates going up, and the market volatility is going back, we believe having exposure to defensive company and maintain a low level of beta would be important. So let's look at the past 5 years of PepsiCo and Comcast to see their stock movement. Do they have a relationship? So we can clearly see that given each market strike, their reaction pretty much is the same. And this similarity level is increasing recently. We can see that it happens more often. So we first analyze the correlation coefficient between the top 10 holdings of Nasdaq based on market cap. It is pretty nice to see that PepsiCo and Comcast has a correlation coefficient of 0.95. So our next step is to test for co-integration. Co-integration is different, and it's important to notice that it is not like correlated. Two correlated pairs may seem correlated, but they are not co-integrated. For example, if Pepsi goes up $100 per day, but Comcast only goes up $1 per day, seems that they all move up to the up. They all move to up, but the spread is actually widening. Our assumption between pairs trading is that the spread between our pairs is going to be a stationary time series, and it's going to, whenever it is widened up, it is going to revert back to the historical mean. So that's why this analysis is critically important. We have ADF test result that p-value of the co-integration level between Comcast and PepsiCo is 0.01, which means we are 99% of confidence to see that the spread between PepsiCo and Comcast is stationary. And the next step is straightforward. Use the OLS regression analysis to find out a hedging ratio, which means for each share of PepsiCo we bought, we need to short 0.72 shares of Comcast. And by utilizing these hedging ratios, let's see how is our spreads looking at. It is pretty nice to see that our spread is actually stationary, and you can see it vibrate and fluctuate around the central mean line. After this has been done, we can apply our trading rules. When the spread zero score is bigger than zero and reaches the upper threshold of plus zero point 0.1 sigma or negative zero point 0.1 sigma, if it's plus 1, so we can know the spread is overvalued. So we need to sell one share of PepsiCo and buy 0.7282 shares of Comcast. And we close position when the spread of this score crosses zero line, which means the spread is closed. And on the other side, if the market undervalue our spread, we need to buy one share for PepsiCo and sell 0.7282 shares of Comcast. Let's see our result. So luckily we have a strategy cumulative return graph like this. And last but not least, our conclusion would be pairs trading, they have decent advantage of market neutral. You do need to worry about how the market is going to be and how is that going to affect your portfolio. Another thing pretty nice about pairs trading is that it is self-funding. The fund you get from the short selling could actually be used to compensate your capital requirement for your long position open. But it also has some bad things because the contrarian risk we are targeting on the reversal, the reaction, the correction of the overreaction price movement. What if we miss the overall trend and the momentum? That would be one to consider. And execution risk. Each time we trade, the transaction cost is doubled, and it increases the risk of trapping bid-ask spread and not having enough liquidity. Last but not least, our quantitative result is cumulative return of 1.29%, and our Sharpe ratio is 1.12 with a CAPM alpha of about 0.12. This is not high, we can admit that, but our taste of this portfolio and this strategy is to give you exposure to the defensive company. But as time goes by, you are hedging your portfolio and increase the reliability and resistance of your portfolio. So thank you for watching, and please feel free to share your comments in the comment area. Bye.